Hello guys, welcome back to lesson 13 on correlation and asset divergence. And on today's lesson, it's not going to be as lengthy as the other ones. It's going to be really straightforward because it's a really pretty easy concept to grasp, or at least that's what I think. So as usual, we're gonna start off with defining the concept conceptually, and I think I'm gonna go with use the CHF for the blank chart. And as usual, we're going to draw out some diagrams to define correlation and divergence. Alright, so what are correlated assets? Correlated assets are assets that move in tandem with one another. So if one asset is trading lower, then the correlated asset has to trade lower. If one asset is trading higher, then the correlated asset has to trade higher. Now, the thing with correlated asset, which and I'm gonna go a little bit deeper into the concept of correlated assets. So we have something called regional currencies. Okay, so I'm gonna type this out so you understand what I'm saying. And this is called regional currencies. And now let's define regional currencies. So we have different regions, obviously. We have North America, we have South America, we have Europe, and then we have Asia, which is also blended in with I call them Oceania, which is Australia and New Zealand. New Zealand. Those are the main regions of the world. And for North America, we have U.S. dollar, we have Mexican. I think it's pesos or so. Mexican pesos, and then we have Canadian dollar. Okay, so that's CAD. So that's the main currencies for North America. Now we don't trade South America currencies because they're not as heavily traded as the North American counterparts. So we're gonna go to Europe, and the main currencies for Europe, we have pound, we have euro, which is for France, Italy, Germany, and a bunch of other European countries and nations. And then we have the Swiss franc. So we have pound, we have euro, and then we have Swiss franc. And then for the third region, which is, I call them Oceania, which is the islands, Australia and New Zealand, we have Aussie dollar, we have New Zealand dollar, and you can add in yen sometimes. Okay, but now when it comes to North American assets, the main one here is US dollar and Canadian dollar. Okay, those are the main assets. So we have USD, we have Canadian dollar, and then for Europe, we've got pound, euro, CHF. They're the three main assets for currencies for Europe, and then Aussie and New Zealand are more closely related than the yen. So we have Aussie, and then we have New Zealand dollar. Now let's talk about correlated assets and their relationship, how that relationship comes about. Okay. Now we have something called a major currency, and this is your like Forex Basics 101. Okay, so what are major currencies? Major currencies are currencies that are paired up with dollar. Now, as of right now, dollar is still the reserve currency of the world because that's what that we call it petrodollar. So if you're doing oil transactions or energy transactions, you have to use dollar. But recently, that's when I say recently, I mean this month and late last month, there's been a huge shift away from dollar to other currencies. Okay, so I'm not sure in the future dollars are going to be the reserve currency for the world, but right now it still is the reserve currency of the world, and we treat it any pair that's spread up against the dollar, any pair from any of the listed ones above that's spread up against the dollar, we call them majors. Okay, so if we pair a bar Mexican pesos because it's not as traded as the other pairs. So let me remove Mexican pesos out of this list. It's still a North American asset, but it's not as heavily traded as others, so it does not need to be on the list. Alright, so let's go. So I've used a CAD from the pairing between US dollar and Canadian dollar, that's a major currency. And then we have GBP dollar. Okay, that's the pairing between US dollar and pound. And then we have Euro dollar. That's the pairing between euro and dollar. And then we have, I'm sure this is all basic stuff, USD CHF, RCSD Swissy. That's the pairing between US dollar and Swiss franc. And then we have Aussie dollar. We have New Zealand dollar, and finally we have dollar yen. Okay, so these are the majors, that the most heavily traded assets or currencies. There are these ones. Okay, so for pound, combination with dollar; for euro, combination with dollar; Swiss franc, combination with dollar; also combination with dollar; New Zealand, combination with dollar; and yen, combination with dollar. Now, what I want you to ask yourself is, what's the common denominator between all of the majors? Okay, so these are the main majors. There are 1, 2, 3, 4, 5, 6, 7. So these are the main 7 major assets, meaning they're the assets with the most volume in the currencies. So what's the common denominator amongst all these different assets? That dollar pairing. Okay, so anyone that has dollar behind it, okay, then what we're measuring is we're measuring the strength of that asset against dollar. Okay, so the base currency is pound, the code pair dollar. For you as a CAD, the base currency is US dollar, and then the code pair is Canadian dollar. For USCHF, the base currency is US dollar, and then the code pair is Swiss franc. For Aussie US dollar, the base currency is Aussie, and then the code pair is US dollar. For New Zealand US dollar, the base currency is New Zealand, and then the code pair is US dollar. So we're measuring the value of dollar against New Zealand dollar here. We're measuring the value of yen against the dollar here. We're measuring the value of Swiss franc against US dollar here. We're measuring the value of dollar against euro here. We're measuring the value of dollar against pound here. And then finally, we're measuring value of Canadian dollar against US dollar here. Okay, so that's the relationship. Now, when you're looking at correlated assets, okay, you're looking at asset with a common denominator. So the common denominator on the code pairs, that was a hard word to say. If the common denominator on the code pairs is dollar, okay, then we expect them to move in tandem. Meaning, if pound US dollar is going higher, then we expect euro dollar to go higher, we expect Aussie dollar to go higher, we expect New Zealand dollar to go higher, because the code pair, which is common to all of them, is US dollar. And then we expect USD CHF, USD JPY, and USD CAD to trade lower, because that code pair, which is dollar for the other four, now becomes the base currency. So this is how the correlation works like. Okay, so we have, if dollar is bullish, so dollar is DXY, okay, if dollar equals bullish, then the natural delivery should be GBPSD, Euro US dollar, Aussie US dollar, NZD, that's New Zealand US dollar. We want to see them be bearish. Why? Because dollar is bullish. If dollar is a code pair and this is very bullish, then the value of the base currency will decline against the value of the code currency, and that's where you get bearishness on all of them. This is the natural delivery. Okay, and then for the assets in which dollar is the base currency, we expect them to be bullish. So we're looking at USD CAD, we're looking at USD JPY, and we're looking at USD CHF. Okay, so if dollar is bullish, we expect USD CAD, USD CHF, USD JPY to be bullish because the base currency is dollar. So the value of dollar is increasing against that of the currency. So this is the correlation. So when we talk about correlation, this is what we'll talk about. Now you can also apply this for cross pairs. Okay. So again, you look for cross pairs with the same denominator. Okay, it could be cross pairs that have the same base pair or cross currencies that have the same code pairs. So for example, if yen is strongly bullish, if Japanese yen is very, very bullish, okay, so let's do it this way. Let's switch up the typo. If Japanese yen is strongly bullish, then what we expect is NZD-JPY and Aussie yen to be very bearish, because again the code pair here is yen. Okay, so expect them to be very bearish against the yen. Plus you're also from the same region, so they're very closely correlated. Now if yen is bullish, we also expect pound yen and euro yen to be bearish, just like that of Aussie and New Zealand. But now it might not necessarily be bearish because they could see more strength against that of New Zealand and Aussie. So the correlation between pound yen and euro yen against New Zealand Japanese yen versus Aussie Japanese yen is not that close. Okay, so this could be neutral. It could, matter of fact, it could even be bullish. Okay, if pound or euro has the same strength. So when you're doing that for the cross pairs, you want to make sure that you're using, when you're looking for divergence, which I'm going to talk about next. So there's an asset on correlation divergence. So when you're using divergence, you want to make sure if you're doing that for the cross pairs, you're doing that for cross pairs from the same region. Okay, so if I wanted to compare yen as a cross currency, I'm not going to use Aussie JPY with Euro JPY to look for divergence. I'm going to use New Zealand JPY and Aussie JPY to look for divergence because you're closely correlated assets from the same region. And if I wanted to do that same, if I was looking for a trade on Euro Yen, I'm going to look at pound yen to confirm divergence. Okay, if that makes sense. So this is your classic correlation. Okay. So what that simply means is if dollar is making higher lows, we want to see cable make lower highs. We want to see euro dollar make your lower highs. We want to see Aussie dollar make lower highs. We want to see New Zealand dollar make lower highs. They want to see USHF make higher lows. We want to see USJPY make higher lows. And we also want to see US CAD make higher lows if dollar is making higher lows. So this is what I mean in terms of correlation. Okay, so if dollar is doing something like this and dollar is making a higher low at a discount, then we want to see euro dollar make a lower high. We also want to see cable make a lower high and get in sync with dollar. So this is going to be your US dollar, and this is going to be JPS dollar. Okay, so this is classic price consolidation. Correlation. All right. So if dollar is making lower lows, then want to see your dollar make lower highs, and you want to see cable also make lower highs because you're trading in very close correlation against dollar. Now let's go into divergence. And a lot of mistakes institutional traders make when using divergence is they use divergence as an analytical tool, which is a wrong method of using divergence. And I want to repeat myself and make sure I emphasize myself, because this is going to be really important for future lessons. So on the live sessions and the evening commentaries, I want to make sure that this is very, very clear. Divergence is a tool for confirmation of your analysis. It is not an analytical tool. Okay? When you've done your analysis and you're looking to confirm order flow, remember our institution sponsorship. A confirmation of institution sponsorship is what we call divergence. Correlated asset divergence is a confirmation. So this is what I mean. If dollar is at a key higher time frame support and or discount, and we're looking for displacement in dollar, and we see higher lows coming to dollar, then we preferably want to see lower highs and lower highs on all the other assets, on the correlated assets. But now, if we see higher high on euro, something's wrong. Because euro is supposed to make a lower high because dollar is making a higher low. But euro is not making a lower high. Instead, euro is making a higher high. What's happening there? This run higher is the Tarsub short. That's a stop run. This is what we call professional distribution. Or if it was inverted and dollar was making higher highs, okay, or dollar was making lower highs and euro dollar was making lower lows, that would be professional accumulation. So I want you to repeat this phase, just rewind this the last 1 or 2 minutes to really let what I just said sink in and you fully can grasp what I'm saying. Okay, so higher lows, alright, it's supposed to be lower highs, but here it is higher high. That's divergence. Okay, that's professional distribution. This is professional accumulation. Even though it's not running lower, but that's also professional accumulation. So what that means is we have smart money participation in delivery of price. That's how we get divergence. Okay, remember, it's only a tool for confirmation. It confirms your preconceived biases. So let me use the most recent example from Friday's analysis. Alright, so now on Thursday, I mentioned the downside objective for dollar was here, and I don't see us trading far below that. That was the downside objective I gave you guys on the start of the week. So let me go back, and that objective was, let me just quickly go back so I can show you guys what that was. So you can go and watch the commentaries for this week, for those of you guys who are new members, and you're gonna see me call the low on dollar. All right, so the opening gap on Thursday, 2nd of February, which is 2 months ago, the closing price on Wednesday, the closing price on 1st of February, Wednesday, was 101.171, and then the opening price on Thursday, 2nd of February, was 100.85, okay, which is a daily opening gap, which we've talked about before. All right, and that's it here. So that's a discount rate, okay. So we have a discount there, and let me get rid of all of the annotations here. So there's a lot of stuff I need to get rid of. Okay. And remember, on Thursday on the Discord, I said I'm not, even though I could have traded TGIF, I'm not looking to trade continuation, because I believe that the objective we had on dollar has been met. So just no reason for us to, and we had a profitable week, so there's no reason for us to push it and look for reversal trades, which we did have on Friday. So this is what we call a TGIF setup. I'll teach you that kind of trade on the short-term trading module. Now, what I want you to watch is dollar at that discount. So that discount is the discount low of that daily opening gap from 2nd of February. You can see between Asia to to London open. So this is Asia's low. That's the lowest low during Asia, and then this is the start of London session. Okay, so the low from Asia to the low from London session on dollar, we can see running higher. Okay, now what should we see your dollar be doing? If dollar is running higher on the lows, okay, what should your dollar be doing? It should be making a lower high, because dollar is making a higher low in price. It's not just random. Again, it's not. I'm not just going into price. I'm trying to look for divergence. Okay, or I have a preconceived bias, which I talked on the session on Thursday. Okay, Friday could be a TGIF, meaning reversal setup, and it has to be at a key level, and that key level is that discount low of that daily opening gap from 2nd of February. So that's a key level at a specific time of the week to validate reversal setups. There's a very specific time window of the week to validate reversal setups. So I'll teach, but I'm trying to teach the concept of divergence today. So what we logically expect Eurodollar to do is want to see Eurodollar make a lower high. So now let's see Eurodollar between the low from Asia, which is here is 3, to the low from London, which is 645. So between 3 and 645, we want to see Eurodollar make a lower high. So let's identify start of London session here. Let's look for 3, and that's 3. Let's look for 645, that's 645. Then let's measure, and you can see it's running slightly higher. That is correlated asset divergence right there. Now, what level is this? Did I just really clear up my chart? I think it did. Man, I took off all my annotations. That's sad. Alright, so let me bring back on the annotations because there's an higher time frame level there. Alright, so we have a fair value gap. There. Here. That's a daily fair value gap, daily inefficiency. And then we have a small little daily volume balance there. Alright. So now, if I went back down into the lower time frame, you can see it's not just any random level. Okay, so let me go back out to that daily time frame I was talking about. And you can see all of this decline lower. Last up candle. Bearish order block. And take it back out there. And you can see around the confluence of that daily fair value gap, which are slightly through, but that's not really the point. Okay, it's still around the high time frame level. Again, I'm not saying you go into the marketplace to look for shorts where they have a preconceived bias. The preconceived bias is price should see a reversal, okay, because it's Friday, time of day. Where's it going to reverse up down into? What I've taught you guys before. Take the entire range for the week, okay, and you're looking for 30 to 50% of the range to be recovered. So if I go my Fibonacci, again, I'm not trying to teach TIF, I'm just discussing the concept of divergence. You can see 30% is here, and what's resting at 30%? Sell side liquidity. Alright, so we don't need Fibonacci to measure all this. I was trying to be systematic with the approach to TGIF, but we already know that sell side liquidity is what we're going to be reaching for. Okay, now look at what happens next. So we can see that price Eurodollar is trading higher against that of dollar. Now what we'll look for is we'll look for institutional sponsorship, meaning we're looking for displacement away from the high time frame level after running a short-term high. Okay, so as we run lower, this spike higher, that's as a result of news. Okay, now we've not taken our sell side liquidity yet. At the numbers release at 8:30 a.m. Eastern on Friday, that was yesterday. Okay, Sunday for me, so that was 2 days ago on Friday. Right? You can see we have a spike up. It's still up above the liquidity here. Again, remember, anything up above here, that's all a buy side liquidity pool. Okay, that's all buy side liquidity pool. So anyone who is going long, they're being triggered to go long. Anyone is trying to sell short here, boom. Okay, and guess what happens next? Massive displacement. Institutional financial drill into sell side imbalance price and efficiency. Again, you're not looking for a complete closure of the range because the CB and not a fair value gap, and small little displacement propulsion block, 1-2 candles, their propulsion block, and look at what the propulsion block does. Displaces price lower. Okay, then this kind of trades up into consequent encroachment of this week, and then displaces and runs for sell side liquidity. So what I'm trying to bring up here is that the SMT, and I'm trying to use the most recent price action, which is from Friday. The SMT on the highs confirmed institutional sponsorship. So once you identify SMT and then you see displacement, that confirms that institutional sponsorship you're looking for. And that's how you get correlated asset divergence. So in the live session, you're going to see me talk about this a lot more often. And this is where the concept comes from. And this is what the concept entails. So hopefully you understand this. If you don't fully grasp the concept and you have questions around the concept, you can ask me on the live session. And I'll add that as a supplementary video for module 1. Okay? So I don't know what the... I'm not sure what questions you guys might possibly have for me regarding the concept, but I plan to record on all the lessons. If you have questions on any of the lessons, ask me on the live session after live training is done, or market. If we're going through price, usually after I'm done trading, then I'll do a Q&A session. So on those Q&A sessions, you can ask the questions and I'll answer them, and I'll title them as a supplementary video for new members who are looking for the course. So thank you guys for watching the video, and I will talk to you guys on lesson 14. It's going to be a continuation of the market maker traps, falls on the shoulders, aka Hounds of Baskerville. So that's going to be really fun, and I'll talk to you guys in the next video. Trade safe.